Hey, in this video, I'm going to talk about installment sale. So, what is an installment sale? This is from IIS on the publication 537 in 2020, page 2 and 3. So, basically, IIS say an installment sale is a sale of the property while you receive at least one payment after the tax year of the sale. Each payment of an installment sale usually consists of the following three parts: return of your adjusted basis in the property. This part is tax-free. Then the second one is the gain on the sales. So this is capital gain tax. Then the third one is the interest income. Is taxed at an ordinary income tax. We're going to talk about this, how this is going to be calculated. So before we go into installment sale, you need to understand a gross profit percentage. So basically, what is this? Say if you have a property, you have a sales price. Let's say $500,000, you bought it for $300,000. $300,000 is your basis. You have a $200,000 profit. So that's profit. Then your total contract price is your sales price. So $200,000 over $500,000, which will give you a percentage is 40%. So this gross profit percentage, you're gonna use this one to figure out what type of gain in each installment payment you will include it in your capital gain. Pay the capital gain tax on it. So that's why they need this gross profit percentage. So yeah. Then basically they have just said divided your gross profit from the sales by the contract price. So this is how you get the gross profit percentage. So one thing they say installment sales income. So basically what it is, that's the gain. That's the gain on the each installment. So they say installment sales income here. Give you a quick example here. Just say basically your contract price, sales price is $6,000. You have an adjusted basis is $4,500. So your gross profit is $1,500. So which give you a gross profit percentage of 25%. So here they just say, I know here you may not understand, but just say after subtracting the interest, you report 25%. Each payment includes down payment as installment sale income from the sale of the year you received the payment. The remainder balance, each payment is tax-free. Return your adjusted basis. So let's see an example. So here is an example. Megan sold some land via an installment sale for a total contract price is $500,000 on January 1st of the year 2021. Her adjusted basis in the land was $300,000 at the time of the sale. The agreement is specified a down payment of $100,000 with the remaining $300,000 sales price paid over the next 5 years at 10% of the interest in the annual payment. So basically, you have a land, Megan has a land $500,000. Right now she sell $500,000. The basis she bought was $300,000. So she recognized a $200,000 gain, right? So then the buyer side, I'm paying you $100,000 today. Then the remaining $400,000 I'm gonna pay you for the next 5 years. Then I'm gonna additionally pay you interest 10% on those installment sale. So in this case, let's figure out here for IRS reporting again, you can choose use the installment method. So what is the installment method is they allow you to spread out the $200,000 gain in the installment payment, which is the installment method. So for this example, we first look at the not use the installment method because it's complicated. Let's see not use the installment method. So basically, IRS say if you elect not to use the installment method, you generally report the entire gain, which is $200,000. Here, of the sales, in the year of the sale, even though you don't receive all the sales proceed in that year, so basically, still, the buyer still pay you installment, but you already recognize the gain. You recognize the $200,000 gain in the year of the sale. You paying capital gain tax on it. So when you elect not to use the installment method, then you can see here, I'm just say your entire capital gain is $200,000. You're gonna report this in the year 2021. So how about your interest on this $400,000? Here, that's the schedule. You can see first you have to figure out what's the buyer's payment, right? This is exactly very similar to mortgage payment. The buyer gonna pay you $105,518 every year. The payment every year, that's the buyer gonna pay you for 5 years, next 5 years, right? However, each payment you have portion is interest. Interest is 10% on your balance. Then you have a portion is your principal, right? So here for the year one first is $40,000 is 10% of the balance. $400,000 is your interest on the year one. Then the principal is your total received payment minus your interest. Then the rest is your principal, right? The principal, you're gonna pay down your balance. So this as, let's say the year two, you receive the payment, then portion 10% of the balance is equal, 10% of balance is equal to the interest. Then the payment minus the interest give you the principal. This principal gonna pay down the balance. So balance reduced this amount. So as this goes, exactly in the year 5, the buyer gonna pay off their the entire $400,000. So you can see this is their interest. Each year you have to pay income tax on those interest on this one. So that's the interest. So basically, when you do not use the installment method for the year you sell your property, you have to recognize the entire $200,000 gain. Then you in the year one year sale, you don't recognize any interest. But for the next year, you will receive the interest. You'll recognize the interest income. You pay income tax on those interest income. Then from the year 1 all the way to year 5, you have to pay income tax on the interest you received. So then when you elect to use the installment method, so basically you can spread your gain within, from year 0 all the way to year 5. So within 6 years, you can pay your capital gain in 6 years rather than in the first year, right? So then you need to use the gross profit percentage here, which we calculated. You know what's your gain is $200,000. What's your sales price is $500,000. Give you 40% on this percentage. So in the year of the sale, year 0, right? The buyer pay you $100,000 basis, pay you $100,000 the down payment, then you $100,000, then you 40% are gonna be recognized as a gain, so you're gonna pay capital gain tax on the $40,000 on here. How about year 1? Year 1, so basically say, well, you're gonna receive a payment this much, then the interest is $40,000. Then basically you receive this principal. They say, okay, we're gonna spread the gain on the principals, so the 40% of the principal gonna be taxed on the capital gain. So you have a 40% on the 65,518. So on this amount, you're gonna be pay capital gain tax on this. So you can see the principal amount increase each year. So your capital gain tax will increase. However, your interest, the interest income always the same. So interest income always same. So every year you will pay interest, pay ordinary income tax on the interest, pay the long-term capital gain tax on the portion of the capital gains. So when you use installment sale, you spread your capital gain within 6 years here rather than in the year 1. So that's why it's beneficial to you use the installment method, because you don't pay the tax at the same time. You may reduce your tax amount, right? So there's another situation is, how about your property is you have a depreciation on it. Let's see this example. Let's say Megan now is not selling land. Land cannot depreciate. So Megan sell rental property. Everything else are the same. Only there's a $150,000. There's a depreciation on it. So when you have a depreciation, the IRS say, if you sell a property for which you claim or could have a claim a depreciation deduction, you must report any depreciation recapture income in the year of the sale, whether or not an installment payment was received that year. So basically, well, in this situation, let's see it again. So your gain will be total $500,000 sales price minus your adjusted basis is your basis minus the depreciation, which give you total gain is $350,000. Within the $350,000, you have $150,000 is a depreciation recapture. This is 25% of the gain, right? 25% tax rate. So you still have the $200,000, the regular long-term capital gain. So just for the year 0, you have to pay 25% tax on those depreciation recapture $150,000 plus on the year 0. If you use installment sale, then you still have to pay long-term capital gain on the $40,000. So you pay basically, you have a depreciation recapture at the year of sale, and you have a long-term capital gain. So this is when you have a depreciation situation, and the rest will be the same as the previous example. Then your interest, of course, you have the interest income as well. So it's the same as the previous example. So here I want to highlight this. IS said if you sell depreciation property to a related person and the sale is an installment sale, you may not be able to report the sale using the installment method. So basically, if you sell a depreciation property to your family member, so you cannot spread out your capital gains, within those years. So basically, you have to recognize your capital gain in the year 0. In this situation, say if you sell to a family member, then you have to recognize the capture depreciation capture $150,000. Then the ordinary long-term capital gain is $200,000. So basically, entire $350,000 gains you have to recognize in the year of the sale. So if you sell a depreciated assets to a family member or whatever is related to you, which is IRS publication 537 on page 6, you can find out who are the related persons. So I just mentioned, so this is IRS publication 537 is everything about installment sale. You can find it here. So here's the link.